Yo, what is going on, guys? It is Drew here with Invest Together, and today we're going to be talking about anything and everything to do with options. A lot of the things inside the stock market are pretty self-explanatory. However, options can be one of the things that trips up a lot of new traders. So I figured what better way than to come out with a video of all the tips and tricks that I learned when I was first learning about options myself. Now, before we further our understanding on how to trade options, I did want to put out a special thank you to all you guys that have been showing amazing amounts of support on my past videos, as well as all the new likes and subscriptions that have been coming in. Lastly, I wanted to remind you guys that I am not a financial advisor, so please do not take anything that I say as legal advice. I'm simply giving you guys my opinions on what I've learned in my investing career and trying to pass that knowledge on to you guys. As I always say, now that we're done with the boring part of the video, let's jump right into how to trade options. The first step in understanding options is simply understanding the definition of an option. An option is a contract giving the buyer the right, but not the obligation, to buy or sell the underlying asset or shares at a given price before a certain date. Now that we understand the overall definition of what an option is, it's important to understand the difference between a call and a put. Basically, you would buy a call if you're making a bet that the stock or share price is going to raise higher, so you're betting on that company succeeding more so on the short term. And a put is the exact opposite. You are betting on a company to fail in the short term, therefore you're selling your shares at a given price, whereas in a call, you're buying your shares at a given price. So that is the difference between a put and a call option. Now, for learning about options, it's important to know the difference between trading options and trading shares and the reasons behind both. Now, for trading options, we can secure a lot more equity of a company with a smaller amount of cash, which in turn can give us a lot bigger returns, versus if we buy shares, we're basically following the percentages of those shares and just getting our profit based off of the share price. So that's kind of the difference between the two. With a lot less cash, a lot more people like to play options because they can get a lot bigger returns on their investments. But they can also lose it a lot quicker if they don't play options the right way. Now, later on in the video, I will be going through some of the minor things that can affect options, but the gist of it is to understand that you are basically paying a premium for a larger equity inside of a company, and in turn, it makes it a lot easier for you to make money, but it can also make it a lot easier for you to lose money depending on where that share price goes in the near term, depending on how you're playing your options. Now that we have a good understanding of options and how they work, as well as why they are used, it's also very important to understand the smaller details that can affect an option. Now, what I have up on the screen right now is actually Snapchat. This is a current call that I'm into right now, and I wanted to use this as kind of an example to explain why I initially got into the call, as well as kind of explain some of those micro details that I paid attention to while buying the call itself. So the reason why I bought the call itself was because I knew that earnings were coming out on the 4th of February, so I was expecting a pre-earnings run-up, which indeed did happen. Okay, the stock is up over 10% since I initially bought into it, which makes my call options up 55%. So that is a large increase on share price versus call option price. So I've made 55% on that. And to kind of go into details about understanding call options and which ones you want to be buying, I bought this one initially for $2.40. As a $60 strike price. So basically what that means is if I bought this for $2.40, right, as the premium, then I am betting that by the 12th of February that is going to be at $62.40. That's my break-even price because I'm paying that premium, and then my strike price is $60, and that's when my call is in the money. So I have to be actually above that by $2.40 to make my money back, right? So that's kind of my goal and what I'm looking for. But I can also sell a lot earlier if I don't. Maybe even if I don't think that that's going to hit, I can sell a lot earlier even if it just runs up, right? Because those options will gain value as the stock obviously runs up. Another thing to pay attention to, right? And the best thing the way that I can explain this is your delta is very easy to understand, right? Every single dollar that the share price goes up. So if this was at $56, right, and it went up to $57, you are then gaining $44 on your call, or 44 cents per share. Remember, every single call is 100 shares that you are basically locking in equity for. Okay, so you would be gaining 44 cents per share times 100, so that's $44 per call that you are in. Now, if this were to run up $3, then you would be making about $132. So you kind of understand how options can make a lot more money. And remember, I only paid $2.40 for this. So if this runs up, I mean, $4, right? I'm making $160. I'm making almost 70% of that option back. But if it runs down, then you can obviously see how you would lose a lot more money from that, because the delta is affected up and down. So if it goes down $1, then you're losing $44 on that call as well as getting hit by other things. Now, the other main thing to understand is theta. Theta is basically every single day that the market goes on, it's taking off $22 from that call option itself. So every single day, in order to break even on my calls, I would be having to make half of $1 in order to stay even with that theta. and in turn be at least going even on my calls or making profit by doing more than that. So that's kind of the basic understanding of what I was trying to do when I bought these snap calls. I obviously wanted to buy them a little bit further out than the actual earnings date, so I could, if I wanted to hold a couple past earnings, then I could see them run up, or I could potentially cut my losses if we do see a sell-off after the earnings report is coming in. So that's my basic understanding, or that's why I went into my Snapchat calls, and that's the best way that I can understand or describe option calls for you guys. Now I get it, options are very confusing when you're first getting used to them, but the more and more that you pay attention to them, or even trade them with paper money, you will start to get the hang of it a lot easier than most. The other thing that I did want to explain to you guys is what put options are like and the difference between them and calls. Obviously you guys know, if you're buying a put, you're betting against a stock. So if I were to bet on, or if I were to buy a $56 strike price put, then I would be paying a premium of $4.49. So my break even would then be subtracted from this 56. So that would be my break even at 51.51 now. If I were to buy this, then every single dollar that the stock goes up, then I'm making 43, or every single dollar that the stock goes down, because we're betting against it, we would then be getting $43 in return, because we have 100 shares and we're getting 43 cents per share. And then from there, the theta is the exact same thing, except for the theta is every single day that goes by. Okay, you are needing that stock to drop at least half of $1 in order for you to make your money back. So very similar. Obviously, I grabbed a 56 versus a 60, so these are very similar. But if I were to buy these puts are now in the money, so they're going to be more expensive than the other ones, right? So this is going to be a $6.80 put, whereas these option calls are going to be in the money, and those ones are going to be a lot more expensive. So you can understand that you're betting on a put if the stock is going to go down, you're betting on a call if the stock is going to go up, and that's pretty easy to understand. And a lot of the Greeks is what we call them, the delta and the theta, are very similar. If you scale them diagonally. So if an in the money put versus an in the money call, those are usually going to be very similar in pricing as far as your premium goes. Now that we have a pretty good understanding of the Greeks and how they affect the puts versus the calls, it is also very important to understand one more small detail, and that is the idea behind IV. Now IV stands for Implied Volatility, which essentially means that it is literally the volatility that is implied by market makers of a given stock. So if a stock has a earnings report that is coming around the corner, then the implied volatility of that stock is going to go up, which makes the calls a lot more expensive, because usually when that implied volatility goes up, there's some kind of news that's around the corner and we're waiting on that, and when that news comes, it could cause a dramatic strike increase, or a price increase or a price decrease. So that's why all the implied volatility kind of comes into play, and it makes a lot of these contracts a lot more expensive. But basically all that it is it's surrounded by catalysts, and if catalysts are surrounding the stock, then that's when the implied volatility goes up. And same thing with, it can also be affected by just overall market health in general. But that's another thing to keep into account when buying your call option. So keep in mind, you're looking at those deltas, those thetas, and looking at what that break-even price is for you, and make sure that it's a realistic call for you to be making money on when you're buying that premium, essentially. The last thing that I'd like to cover with options is to make sure that you guys are being smart with your investments. Remember that not every single trade has to be a home run, and always go into every single trade with a given strategy or plan. Once that goal is reached, then you can happily pull out of that trade with the profits that you have and not feel like you have to risk your hand any further. Now, to recap the video and everything we went over, we covered 4 main topics. Those 4 topics included the definition of options and what that exactly means, as well as when/how to use options. So that's 2. We also learned how to understand the important details inside of options, things like delta and theta, and how those can affect the option that you are buying. And lastly, we covered how to manage your risk when trading options, which is also a very, very important part when it comes to trading in general, but especially when it comes to options where the percentages are a lot higher. Those of you guys that have made it this far in the video, I do want to say thank you guys so much for all the continued support, as well as I'm very hopeful that you guys were able to take away a thing or two about options moving forward into your trading days. If you guys did enjoy the video and you do enjoy the content that I continue to provide, feel free to hit that like button, as well as drop a subscribe to me. It does mean a lot and it keeps me motivated for making more videos. Again, guys, this has been Drew with Invest Together, and I'm out. Peace.